Hi, I'm John Persinos, Editor-in-Chief of Aircraft Value News. Welcome to my latest video presentation, recorded January 26, 2026. In this video interview, we'll turn our focus to money, specifically how to make smart investment decisions in today's market, with insights from my guest, Jay Hatfield. Jay Hatfield is CEO of Infrastructure Capital Advisors, ICA, and is the portfolio manager of a series of exchange-traded funds and hedge funds. He leads the investment team and directs the company's business development. While this interview ranges across capital markets, its relevance to aircraft appraisers, lessors, and financiers is direct and practical. Aircraft values and lease rates do not exist in a vacuum. They are ultimately shaped by the same macro forces that drive equity valuations and capital allocation decisions. Jay, thanks for being here today.
John, it's great to be on.
I really appreciate it. Okay, let's get right to it. Jay, given my large aerospace audience, I'd like to begin with a question about Boeing. Boeing has had its reputational woes. Regulatory oversight has cracked down on the company due to some fatal accidents. Boeing has been accused of cutting corners to boost profits, and it's suffered some real damage, loss of clients. But now, under the new CEO, Kelly Ortberg, the company seems to be turning itself around. The stock has been in a slump, but it's rebounding. My question is Boeing undervalued according to its future growth prospects, or is it still too risky and not quite the stable blue chip it used to be?
Well, certainly it does have an element of risk because there can always be a new safety issue. But Kelly is 100% focused on reinstalling the engineering culture, the safety culture, and sort of making money, number two. And you're seeing increased confidence by customers, new orders, and most importantly, they're not really constrained by orders. It is a duopoly, global duopoly. And so everyone, or maybe not every country, but most countries want to have Boeing planes. The Trump administration in their trade deals are demanding that they buy Boeing planes. So there's good demand. It's really a supply issue. Supply manufacturing is ramping up. It is a risky stock because it's not earning a lot of money now.
Right.
But so we have to value it on 28 earnings, so 2 years out, which we normally don't do. But this is a duopoly, so it's not like it's some risky, chip company, and you're valuing it on earnings. It really just also you're really valuing on an earnings level that's in line with what they earned a long time ago when they were producing normally. So we have a 280 target, which is a multiple on I think it's 35 times 28 earnings. So it's run up a lot. It's getting closer to our target. You're supposed to sell things when they get to the target. But a great recovery story. It's not going away. Something you could give to your children and they could hold for the rest of their lives. So,
Okay. The broader indexes, they all hover at record highs. A lot of analysts are warning of overvaluation. We've been hearing that alarm for a while now due to AI mania. And by just about every valuation yardstick, the stock market is overpriced. Do you expect an imminent correction or something approaching a crash? Because the market is pretty frothy right now, and it's being held aloft by a handful of mega cap tech darlings, the Magnificent Seven especially. Or do you think these warnings about overvaluation that they're overwrought?
Well, like most issues, at least in economics and politics, everything's polarized, but there's nuances. So we do believe that the Mag 8 or the large, we include Broadcom, but the large tech companies are fully valued. Not all of them, but as a group, they're fully valued. But the overall market is trading at about 23 times,
Right.
which might seem like a huge number, but historically, you have to correct for the fact that we had the biggest corporate tax decrease in the history of the world in 2017. So guess what? When you tax something a lot less, it's worth a lot more. So
Right.
our model, so we do discounted cash flow. In theory, for all investments, you should do discounted cash flow. Like if you buy a house and you rent it to somebody, discount the cash flows back. But most people use multiples as a short end. But if we do a discounted cash flow on the overall market, assuming rates are a little bit lower, to be fair, like below 4 on the 10-year, then we do get to 23 times. So we have an 8,000 target on the market for year end 26. We added 7,000 for 25, so we're nearly perfectly correct. Same year before that, nearly perfectly correct. And I think what most investors miss as a final point is that stocks normally go up. It's like if you own stocks, it's like going to the casino, but you own the casino and everybody else is coming to you. So you're going to get your 10% a year if you hold stocks in the long run. But we do believe that growth is continuing with the tech stocks. There's a ton of undervalued valued income stocks like we hold in our ETF ICAP, and that there'll be an ongoing rotation. Tech will do okay, but underperform the market. S&P will underperform the Dow, small caps, and the equal-weighted index. So you don't have to have all of your ideas in tech. There's a ton of other ideas, and those other ideas usually pay dividends. Boeing does not, but pay dividends. So it reduces the risk of your portfolio. If you need to take money out of your portfolio, you get the dividends and can spend them.
But as valuation risk rises, which defensive sectors are beginning to stand out, and what fundamentals make them attractive in the current environment?
Well, it's had a little bit of a run, but and I know it's your core, so maybe you have a better opinion than we do. But we added Lockheed Martin, to be fair, about $50 ago, but because it's clear the defense budget is going to rise pretty substantially, at least this year, while the Republicans are in charge.
Right.
And that's a very reasonable price stock. It's headquartered in my hometown, and very well diversified. So it's not betting everything on missiles or space. It's really in every sector, helicopters, aerospace. So good, reasonably priced way to play that defense spending with a good dividend. I think it's about 2.5% dividend. So that's one area. Your folks probably already all over that.
Let me ask you, how significant a threat are President Trump's on again, off again tariffs, threat to the economy and the stock market? Geopolitical risk, headline risk seems to be increasing. Are these tariffs, are they still a looming threat to the overall stock market?
Well, the important distinction to draw is between normal tariffs that act really like a sales tax on imports.
Right.
So 10 to 20%. We actually think those are at the margin very positive. We're forecasting the US budget deficit drops by 400 billion and goes down to 4.5%, which importantly is a sustainable level because the growth of the nominal economy is about 5. So if you grow debt at 4.5, you gradually, it's not the way I would run it, but slightly improves the debt to GDP ratio. So don't ignore the revenue part. They're very, by the way, I get a lot of blowback on these comments because nobody likes tariffs,
Right.
but nobody likes any taxes. So it's not very surprising. But it's the only tariff that can pass the Congress because the president, at least for now, seems to be able to impose them. And so I draw that distinction between trade war with China or Europe and just normal tariffs. It looks like we're going to have normal tariffs.
Well, that's a great contrarian view. Those are subtle points that you don't ordinarily hear in the mainstream financial media. What sort of economic backdrop do you anticipate as 2026 unfolds?
So the U.S. economy is slow. It in fact is in recession in 2 areas. And also this data is on our website. We have a recession in housing and in construction, like we normally do. So the Fed raises rates, 10-year rises, mortgage, the 30-year mortgage is over 7. That would normally cause a recession. But there's this thing called AI, and for the first time in any tech boom, that actually is impacting the real economy or the old economy way more than it ever has. So most of your viewers probably around for the internet boom, There was no real CapEx boom. You bought, you invested in software, bought some laptops, and hired some software engineers. But you didn't go build like millions of data centers for it. You didn't need that.
Right.
So those two offsets, we have very slow investment. In fact, last quarter, zero growth in investment. But the consumer remained strong. And we also had some benefit from net exports. So GDP is subtracts out net exports, so they actually dropped, maybe because of trade policy or just random noise. But so we had very strong print on GDP. We're forecasting the economy ends this year up 2.7%, and next year goes to 3.3. And here's data you won't get anywhere. The average growth in the economy since World War II was 3.15.
Hmm.
So you'd say, oh my God, three is too high because the CBO, Congressional Budget Office, always says, oh, long-term growth is 1.8. Well, they just made that up because the actual long-term growth rate is 3.15. So we're only forecasting a little bit above that at 3.3. Strong consumer, they're going to get more tax rebates from the OBBA, because if you're lower income and have tips and overtime and it draws Social Security, then you're going to get more refunds. It wasn't in the tax tables last year, so you're going to get refunds. We do think that the federal cut construction will improve. And by the way, when construction and housing are weak, manufacturing is weak because there's a ton of manufactured goods that go into housing and construction, obviously appliances, carpet, paint, etc. So that's our key goal. Why we're going to move from 2.7 to 3.3 is we should have normal investment as the Fed cuts rates and we have lower inflation. We don't believe inflation's sticky. We think it's mismeasured. You can get that on our website. We publish CPI-R. CPI, when you correct for real-time data, is at 1.4, and PCE core, when you correct for shelter, some shelter's mismeasured by the BLS. Not surprisingly, they can't do employment or inflation properly. So we're bullish on inflation. It's going to roll down. We have that forecast on our website too. PC core should roll down to 2.4 by the end of the first quarter. You'll get the rate cuts, and then you'll have a pretty, like a normally strong economy, a little bit held back by slow government spending, but not as badly. That was a big negative this year because of all the federal layoffs. So we're just saying slightly below on the government side, kind of normal on investment side, and pretty strong consumer. But it's important if you do have people come on, or if your clients are just reading the financial press, most of it's wrong. So if somebody says, okay, well, I think the economy is going to grow at 4, if they don't give the components, then they're just making it up. Okay. So it's important to look at those components and say, well, do I think the consumer is going to be strong? Do I think investment's going to recover? Is the all government going to be relatively flat or up? So look at the components, not the overall number, but keep in mind, a little bit over 3 is totally normal. So when people come on, there's a lot of people are too negative. It sounds more intelligent to be negative. Everybody wants to be, called the next Big Short,
Right.
or Enron and be a hero.
Right.
We just try to be like normal and reasonable.
Okay.
So we never get any recognition. It's like, okay, we had a 7,000 target. It was 6,950.
Yeah.
Nobody sends me money. I don't get any awards, but I could have gotten more press if I said we were going to 4,000 or 9,000, right? I would have gotten more attention, but we just happen to be correct all the time. Nobody seems to care, but that's what we try to do, is have reasonable cases. We don't, like, maybe there's a 1% chance an asteroid destroys North America. But we're not going to focus on that. We want to deliver what's most likely to happen.
Well, normal and rational and reasonable, it doesn't drive ratings on cable TV. Final question. You've painted a Goldilocks scenario, which Wall Street likes best, not too hot, not too cold. And liquidity is the lifeblood of the financial markets. So, which leads me to this question, obvious question. What do you think the Fed is going to do in the coming months?
Mm-hmm. Well, I think they're going to pause initially. I mean, it will help. We're not making a political call that they're going to cut. In other words, that they shouldn't cut, and the President Trump's nominees will force a cut. we're making a fundamental call that inflation's coming down,
Yep.
but it's not going to happen by the January meeting, so they're not going to cut. So we'll see. The government data is very unreliable, but we think after February that data will come out, and the Fed does get that pretty early, so they might cut in March if we're correct and it rolls down. But there can still be noise, like shelter is only sporadically coming down. So we do think that you will get those three rate cuts maybe towards the end of the year
I
more.
see.
But as long as they are coming, that'll keep the 10-year low. The 10-year trades at 100 over the expected terminal Fed funds rate. So the 10-year drives mortgage rates. The 10-year drives a lot of economic activity. So as long now the expectations have dropped, they're only like expecting about 40 basis points of cuts right now. So that kind of creates the upside, right? You need to get from 7,000 to 8, you have to have a bit of a surprise. So our call on the surprise is inflation is lower than everybody has feared, but inflation is already low and going lower. And we just need the Fed to figure that out.
Yeah. Jay Hatfield, that was very insightful. Terrific stuff. Thanks for your time.
Thanks for having me on.
You bet.